All right. That's the view coming in. Let's welcome in Drew Pettit, Director, U.S. Equity Strategy and ETF Analysis and Strategy Research at Citi. Drew, great to have you with us here back in the program. Thank you very much for your time. How's the global scene looking? I was saying over the holidays, last 10 days, and everybody is slowly coming back, trickling in. But the dominant theme kind of has been the more hawkish FOMC, right, from December, and how that has moved pricing for 2025. Just your thoughts as we are kicking off this new year. And Happy New Year, Drew.
Happy New Year to all of you as well. And honestly, I'd say yes, the Fed and specifically to us, interest rate volatility has really stolen the show as of late. So it's funny, a lot of times we get questions about the level of the 10-year Treasury that will break U.S. equities or just global equities in general. And we always talk about, 4.5% feels high. But you really get concerned when you break through 4.5% and you feel like you're going to hit 5 and you're going to continue to move higher. So really, it's not just the level of rates that gets us concerned, or at least has us cautious for now. It's interest rate volatility. And honestly, since the last Fed meeting, since that last FOMC, like you mentioned, that's really when interest rate volatility has shown back up. And then that's translated into equity market volatility since then.
Drew, again, Happy New Year from me as well. Thank you for sparing time for us in what is still holiday season. But what surprised me yesterday or over the last 2 days actually is this sharp increase in the dollar index. Would that deter more funds from coming to the EMs?
I think so. Honestly, ever since the Trump election, we've been a little bit concerned about EMs. From a global equity team perspective, we are neutral on emerging markets. But honestly, Trump, tariffs, stronger dollar, higher interest rates, or the potential for higher interest rates in the United States, all tends to be a little bit more EM negative. Where we've seen the most pain globally actually hasn't been in EM. Honestly, EM from a dollar perspective held up pretty well in December. We've seen most of the pain in Europe. And honestly, I would say that's where sentiment is most bearish. Our European colleagues see that in their data. We see that in the ETF flow data here in the United States. So yeah, stronger dollar, definitely a headwind for EM. But right now, investors really have their sights set on Europe as an underweight.
Mm-hmm. Hi, Drew. Good morning and good to see you in. This is Nigel on this side. So from a global equity market perspective, I think you're building in, close to double-digit returns for the U.S. market for this year. If you could help us out with what are the levels you're looking at in the U.S. market. And since there is immense bearishness on the European market, I think you believe it's a good time to get in. Give us your analysis.
Yeah, so it's funny. So on the S&P, we're looking at 6,500 for a year-end target, but our mid-year target is something closer to 6,100. Until we had the recent pullback, that was basically saying you really should expect a little bit more of a volatile, choppy, maybe more sideways first quarter and first half. Some of that got pulled forward into, the holiday shortened and kind of lower liquidity week trading into the end of the year. On Europe, in general, our team, we feel like this is a really interesting barbell here. So the U.S. gives you all of these secular trends and really high growth that's not necessarily macro-driven. And Europe, on the other hand, is something very cyclical. And one market, the U.S., has run aggressively. Valuations are high. Sentiment is very high. And then we look at Europe. Valuations not very onerous. Revision trends by analysts have been unbelievably negative. We really think we've reached peak bearishness there. So overweighting the two actually sets your portfolio up for a pretty interesting barbell for 2025.
Sorry, Drew, Europe and was it the next one? Was it the other one?
So Europe and U.S. pairing the two of them together.
All right, got it. I mean, Europe, of course, is absolutely beaten down. And it's a very interesting take. Probably this year we'll see that market, especially markets like Germany. Germany, etc., by the way, did well. By the time we wrapped up, I think DAX is up 17%, although it looked like it was a nothing kind of a year. Just on that point about the dollar, which my colleague was making, how much of that do you think is a function of the euro? The The Euro USD going through 1.03.
Almost parity.
You think that is more, because when we look at the dollar index, the euro is the biggest sort of weight there, right? Maybe for emerging markets, we should look at maybe the Asia dollar index. I don't know, your thoughts?
Yeah, potentially. But honestly, when I'm thinking about the global equity market in general, I'm okay to look at a trade-weighted dollar or the DXY. Either way, however you want to spin it, that stronger dollar, if it is in response to global macro concerns, whether that's driven by euro or Asian currencies or whatever, it really becomes a problem for risk assets no matter where you are. So to us, like, yeah, right now, a lot of this is kind of driven by trade uncertainty and potential tariff risk. We see that kind of feeding through in the narrative. But if tariff concerns lead to global trade concerns, and that ultimately ends up being a negative relative to our economic expectations for the year ahead, that should reflect negatively back on risk assets. And just kind of tying this together, when we think of the dollar, it's similar to interest rates. If we get big moves in the dollar and we have a lot of volatility there, it gets hard to pay more for equities and risk assets. So again, it's kind of cross-asset volatility does matter for how stocks trade.
Okay. Well, I take your point. That's what shook us about the way the dollar moved yesterday. But despite that, India saw a 1.8% rise with foreign funds buying after a long gap. So we are all confused. In any case, I guess the answers will be known in the days to come. Drew, thank you very much indeed for sparing time for us this morning.
Well, thank you for having me and Happy New Year, everyone.
Likewise from all of us here. Thank you.